January 14th, 2026. 3:45 p.m. Eastern. No breaking news banner, no emergency alert. Just a quiet moment that most people missed and will later wish they hadn't. The United States Mint website was still online, but the market itself had disappeared. The Buy Now button was gone. Not disabled. Not sold out. Erased. Silver Eagles, Morgan dollars, all still displayed like museum pieces. You could look, but you could not buy. That detail matters more than any headline you saw today. There was no public explanation, no press conference, no warning. Hours later, a leaked email surfaced among authorized distributors. One line. Sales suspended due to market volatility. That was the full justification from the sovereign mint of the world's reserve currency. Meanwhile, the media moved fast to soften the narrative. CNBC called it a temporary technical suspension. Bloomberg labeled it a precautionary move, risk management, responsible behavior. Here's the problem. None of that matches reality. Institutions don't erase access when prices rise. They erase access when supply fails. The mint didn't pause sales because silver got expensive. They paused because they couldn't get the metal. And when physical supply disappears, the first thing that follows is denial, wrapped in calm language designed to keep you passive. I've watched markets for decades, and every structural break starts the same way. Not with panic, but with silence. Not with volatility, but with disappearance. The screen price keeps updating, the headlines keep publishing, but the ability to convert paper into something real quietly shuts down. This is the moment most people misunderstand. They assume the system is protecting them. In reality, the system is protecting itself. You're not here for entertainment. You're here because you sense that when access vanishes before price explodes, something underneath has already snapped. What happened at the U.S.? Mint is not an isolated event. It's the first visible crack in a supply chain that has been stretched past its limits for years. And cracks don't heal. They propagate. To understand why this matters, you need to understand hierarchy, not opinions, not narratives. Hierarchy. In every commodity market, there is an order of signaling, and silver is no exception. At the very top of that hierarchy sit sovereign mints. They are not just sellers of metal. They are psychological anchors. When a sovereign mint is selling coins at spot plus a modest premium, it tells the market one thing very clearly: supply exists. Logistics are functioning, and confidence is intact. That anchor was ripped out of the ground. When the U.S. Mint stops selling entirely, the message is not subtle. It's not about volatility, it's about inability. And once that top-tier signal breaks everything below, it begins to destabilize. Private mints follow, dealers widen spreads, delivery times stretch. And eventually the price you see on a screen detaches from the price required to obtain metal in the real world. This is where most investors get trapped because they've been trained to believe the screen is reality. The spot price flashes, the chart updates, analysts debate resistance levels, but the screen price is only valid as long as physical delivery is credible. The moment delivery becomes uncertain, price becomes theoretical. Right now, we are watching that transition in real time. The paper market is still quoting numbers as if nothing has changed. Futures are trading, ETFs are updating NAVs. But underneath that surface activity, the physical market is tightening aggressively. Authorized purchasers are reporting premiums that no longer make economic sense under the old model. Dealers aren't hedging risk anymore. They're rationing inventory. That's the shift you need to recognize. When markets move from risk pricing to availability pricing, the rules change. Rules. The question stops being, what is silver worth, and becomes, can I get it at all? This is not a demand spike driven by hype. This is a supply failure revealing itself slowly, unevenly, and deliberately obscured. The mint going dark wasn't the event. It was the signal that the event is already underway. In the next chapter, we're going to talk about the mechanism that explains why this happens, the one concept that turns a normal market into a stress fracture waiting to snap. The mechanism that explains everything you're seeing right now has a name, and almost no one outside the physical market truly understands it. Backwardation. It sounds academic. It isn't. It's a distress signal, a flare fired into the sky by a market that is running out of time. In a healthy commodity market, the future is always more expensive than the present. That's normal. Storage costs money. Insurance costs money. Capital tied up today has an opportunity cost. This structure is called contango, and it's the default state of functioning supply chains. Futures trade higher than spot because the system assumes delivery will be available later. Backwardation is the inversion of that assumption. Backwardation occurs when immediate delivery is more expensive than future delivery. Think about what that implies. It means the market is no longer confident the metal will be there later. Buyers are willing to pay a premium right now today simply to secure possession. Not exposure, not a contract, possession. This is not speculation. This is urgency. Imagine walking into a dealership and finding the lot completely empty. The dealer offers to sell you a car that will arrive in 6 months for $50,000. But in the parking lot, a private seller demands $80,000 for the car he's driving because it's the only one available. You're not paying extra because you're irrational. You're paying because waiting isn't an option. That is backwardation. And this is where the U.S. Mint got trapped. The futures market says silver is one price. The physical suppliers are quoting another. When the Mint tries to source hundreds of thousands of ounces for near-term delivery, they are being quoted prices that destroy their margin model. They cannot sell you a coin at yesterday's assumptions when today's metal no longer exists at that cost. So they didn't raise prices quietly. They didn't limit quantities. They removed access entirely. Backwardation doesn't resolve itself gently. It either reverses through massive new supply, which doesn't exist, or it forces a repricing event that collapses the old structure. What you are witnessing is not volatility. It's a market admitting reluctantly that the future promises it sold may no longer be deliverable. And once a market reaches that realization, it never goes back to pretending everything is fine. Now we need to talk about numbers because this is where narratives fall apart. Markets can hide stress for a long time with language, but they cannot hide it from math. And the math in silver is no longer balancing. As of this week, tens of millions of ounces are standing for delivery in the January cycle alone. Not rolled, not cash settled, standing. That distinction matters. Standing for delivery means someone is saying, "No, I don't want dollars, I want the metal." And when that demand concentrates in a system built on the assumption that almost no one will ever ask for physical delivery, pressure rises fast. At the same time, registered vault inventories are declining at a pace that cannot be described as normal. This isn't seasonal fluctuation, this isn't logistical noise. This is a steady directional drain. Ounces are leaving faster than they are being replaced, and replacement requires metal that no longer exists in surplus. Now zoom out. Industry estimates point to a global silver deficit measured in the hundreds of millions of ounces for the year ahead. That's not a rounding error. That's a structural gap between what the world consumes and what it produces. Historically, that gap has been masked by above-ground inventories, vaults, ETFs, unallocated pools, stockpiles built during periods of complacency. Those buffers are finite. A fractional reserve system functions smoothly until confidence intersects with scarcity. When enough participants decide they want what they were promised, the arithmetic breaks. You cannot deliver the same ounce to multiple claimants. And when claims exceed inventory, the system doesn't fail loudly at first. It stalls, it delays, it reframes. This is why delivery data matters more than price charts right now. Price can be defended temporarily with selling pressure. Inventory cannot be faked indefinitely. Every ounce that leaves a vault tightens the system for everyone else still relying on promises. The market is approaching a threshold where confidence becomes the scarce resource. Once that line is crossed, behavior changes. Holders of paper claims rush to convert. Institutions prioritize themselves. Smaller participants get pushed to the back of the line. And when lines form in financial markets, most people discover too late that they're not at the front. At this stage, the counter-argument always appears: high prices will fix the problem. Demand will fall. Scrap will surge. Balance will return. It sounds logical. It's also deeply flawed in this context. Industrial demand does not adjust on a short timeline. Silver is embedded into manufacturing processes that cannot be re-engineered overnight. Solar panels, electronics, medical equipment, these supply chains are locked into silver-intensive designs. Substitution requires new tooling, new testing, and new certifications. That takes years, not weeks. A price spike today does nothing to reduce demand tomorrow. Scrap supply tells a similar story. Higher prices do bring metal out of storage. People sell old holdings. Refiners process it. The market absorbs it quickly. Then it's gone. Scrap is not a renewable flow. It cannot resolve a structural deficit measured in hundreds of millions of ounces. It delays pressure briefly, then disappears from the equation. What keeps this misconception alive is psychological anchoring. Prices feel high because recent memory says they are. But history disagrees. Adjusted for inflation, prior silver peaks sit far above current levels. The belief that the market is too expensive is emotional, not fundamental. Supply squeezes persist because participants expect relief that never arrives. They wait for balance while inventory continues to drain and access continues to tighten. Scarcity doesn't respond to comfort. It responds to availability. And availability is what's vanishing. In the next chapter, we'll examine what happens when institutions try to regain control and why their interventions often accelerate the breakdown instead of stopping it. When pressure reaches this level, institutions don't admit failure. They intervene. And those interventions follow a pattern that experienced market participants recognize immediately. The first move is usually mechanical. Exchanges raise margin requirements. Officially, it's about volatility control. In practice, it forces leveraged participants to liquidate. Futures traders suddenly need more cash to hold the same position. Many can't. Positions get closed, selling accelerates, and price drops not because supply improved, but because weak hands were pushed out. This creates the illusion of resolution. Price falls. Headlines declare the squeeze over. Confidence briefly returns. But nothing fundamental has changed. No new silver has appeared. Vaults haven't refilled. The delivery obligation remains. Margin hikes don't fix shortages, they redistribute pain. The second move is informational. Coverage narrows. Discussion shifts away from physical delivery and toward technical analysis. Charts, levels, indicators, anything that reframes the market as a trading game instead of a supply crisis. Attention is redirected from inventories to price action where intervention is easiest. The third move is contractual. Cash settlement becomes normalized. Language buried in contracts suddenly matters. Participants are reminded that under certain conditions, physical delivery is not guaranteed. Force majeure clauses surface. Settlement flexibility is emphasized. The market is prepared psychologically for the idea that paper claims may not convert into metal. This is the most dangerous phase, because by the time cash settlement becomes acceptable, confidence in physical delivery is already gone. The paper market continues functioning, but as a closed loop disconnected from reality. Prices print, contracts trade, yet physical metal trades in a separate universe governed by availability, not promises. Institutional intervention is designed to buy time. Sometimes it works. Sometimes it accelerates the break by revealing the fragility it was meant to conceal. The key is understanding that these moves are defensive, not corrective. They don't restore balance. They manage perception. And when perception finally fails, the repricing is abrupt. Now we need to talk about London because no silver market functions independently of it. London is not just another exchange. It is the clearing hub for the Western bullion system. More silver trades there on paper than anywhere else. And that detail matters because London operates on confidence, not custody. Most silver in London is held in unallocated form. You don't own a specific bar. You own a claim. It's efficient and liquid, but it depends on one assumption that most participants will never ask for physical delivery at the same time. When that assumption holds, the system works. When it doesn't, stress appears quickly. And stress is appearing. Behind the scenes, behavior is changing. Allocation requests are rising. Delivery timelines are stretching. Language from counterparties is becoming carefully vague. These shifts don't make headlines, but they are how breakdowns begin. the market starts asking questions it avoided before. If London cannot honor physical delivery even temporarily, the consequences are immediate. Every institution downstream reassesses risk. If the center can't deliver, trust collapses everywhere. Liquidity freezes not because metal is gone, but because confidence is. This is how paper and physical separate into two markets. Cash settlement becomes normal. Contracts are honored in currency, not metal. On paper, everything functions. In reality, possession migrates away from promises. London doesn't need a dramatic failure to change the system. A quiet move to cash-only settlement is enough. Once that line is crossed, confidence doesn't come back. This is where psychology becomes more dangerous than price. Because when systems strain, most people don't lose money by being wrong. They lose money by waiting for confirmation. The mainstream financial media is structurally late by design. It does not lead, it explains. By the time a narrative is safe enough to publish, the opportunity has already moved. That delay is not accidental. It protects confidence, not viewers. And confidence is the lubricant that keeps fractional systems operating. The trap is simple and seductive. If this is real, it will be confirmed. So people wait. They wait for an official statement. They wait for a headline. They wait for consensus. What they don't realize is that confirmation in markets always arrives after repricing, not before it. This is especially true in physical shortages. When access tightens, information becomes asymmetric. Insiders see delays first. Distributors see rationing next. Retail sees premiums explode last. By the time the public understands what's happening, the decision is no longer whether to act, but whether to accept worse terms. The second psychological trap is paralysis. Complexity creates hesitation, too many variables, too many scenarios. So people default to inaction. They tell themselves they'll decide later when things are clearer. But clarity in a squeeze is the absence of options. Having a plan matters more than being right. Knowing what you will do under specific conditions removes emotion from the equation. Without a plan, every decision feels heavy. With one action becomes mechanical. The market doesn't reward perfect timing. It rewards preparedness. Those who decide in advance don't need permission from headlines. They already know what signals matter to them. In the next chapter, we'll talk about positioning, not hype, not urgency, but disciplined responses to asymmetric risk. Positioning in moments like this is not about excitement, it's about asymmetry. When outcomes are skewed, strategy matters more than prediction. You don't need certainty, you need a framework that limits downside while keeping exposure to upside events that cannot be repeated once they pass. The first mistake people make is treating this as a binary bet, all in or all out. That thinking comes from emotion, not risk management. Real positioning is layered, conditional, responsive. It recognizes that markets can move sideways violently or deceptively before resolving. Physical metal paper exposure and equity leverage all behave differently under stress. Physical protects against system failure, but carries access and premium risk. Paper provides liquidity, but fails when delivery confidence breaks. Mining equities offer leverage, but introduce operational and market risk. None are perfect. That's the point. Balance is not dilution, it's survival. What matters most is avoiding forced decisions. Leverage removes optionality. Margin creates vulnerability. When systems tighten, the worst position is one that requires constant defense. Cash positions and unlevered exposure preserve control. They let you act when others are being acted upon. This is also where patience becomes an edge. Not waiting blindly, but waiting with intent. Knowing what levels, signals, or events trigger action and ignoring everything else. The market will try to exhaust you emotionally before it resolves technically. That's how weak positioning gets shaken out. Most people focus on price targets. Professionals focus on behavior. Who is being forced to sell? Who is being denied access? Who is changing rules instead of meeting obligations? Those answers tell you more than any chart. As this unfolds, the greatest risk is not missing upside. It's being trapped in the wrong vehicle when the rules change. In the final chapter, we're going to tie this together, the structure, the psychology, and the strategic lessons, and talk about what this moment demands from anyone paying attention. This is the point where everything converges. Structure, psychology, strategy. Not into certainty, but into responsibility. Because moments like this don't ask whether you are right, they ask whether you were prepared. What the silver market is revealing right now is not just a shortage of metal, it's a shortage of trust. A system built on rolling promises works only when no one demands delivery at scale. Once that assumption breaks, every participant is forced to reevaluate what they actually own versus what they were told they owned. The lesson is broader than silver. Price is not value when access is uncertain. Liquidity is not safety when rules can change. And diversification does not protect you if all exposures rely on the same underlying confidence. Real risk management begins where